These are the only ways that you need to know to see whenever the market has finally bottomed or about to bottom, and you should be buying and loading the boat with all of your cash on the sidelines. Right here, we have the NASDAQ Q100 versus the VIX. The VIX is the volatility index of the market, and the way that you use the VIX is you take whatever the VIX is and you divide it by 16 to get what the average move that the market is expecting that day. Usually the VIX spikes whenever we're at the very bottom of a recession because people are the most worried, and they're the most worried that the market's going to keep going down so much. Right here on this chart, we have the VIX and how it compares to the NASDAQ Q100. And as you can see on this chart here, whenever the VIX spikes here, right whenever you see the VIX, like we talked about, over $30, like we can go to this link right here and find our VIX here. You can see over $30 of a VIX is a great time to buy, usually at the bottom of the cycles. 40 is unbelievable, and 50 is load the boat. Look what here got up here on the April lows, the bottom day, April 2025. It jumped here in 2024 and it flew up. And I want to even take you back. Look what it got to all the way in 2020 at this time, all the way up to $80. And we all know what happened. The greatest short squeeze after COVID happened, and the market went up. So this is a great way. Whenever you see the VIX super elevated, that's whenever you want to be doing aggressive buying, because you're going to get a bunch of equity at super low prices. And right here, you can just see, look at all the way down here, April lows, the VIX spikes. And then what does it do? It runs up from about 30% more from this spot. So it's pretty important to use, and something that you can use on a day-to-day basis as your average retail trader to help outperform the market. Just even right here, look at down in 2020, like I was showing you, dip down, straight line up. The only thing is, in 2022, whenever we had that huge recession, it got above 30 multiple times that year, which all of them were great long-term buys. But if you loaded the boat too early on, then you missed out on a lot of the move. So it's pretty important just to keep looking and keep an eye. If you see the market down a bunch, like a 20% drop or something, of the over S&P 25, and you get a VIX around 30, you really want to be loading the boat. But say you only see a 5% drop and the VIX is at 30 and the 4Ps are still pretty elevated, then you still want to keep a little bit more cash on hand, even though you do want to be buying those equities that have been beaten down really hard at those times. So this is way one that you can use to use the market. It's probably the easiest one to look at. Just VIX over 30 you should be buying. 40, great. Anything over 50, load the boat, because it just goes over 50 fast and bam, and don't want to miss the moves. Another great way that we have here is the PCE, the put to call ratio in equities right here. Anytime that you see this over even 0.8 is pretty great. That means a lot of people are hedged. And if you even go back to here in times, look at what this got up into 20 at the end of 2022. This is another way that you can use all these in a tandem to be like, hey, let me check this one off, this one off, this one off. Great time to buy with a market down. Look at it, got up over 1.5 here at the bottom of 2022. Look at in 2020 at the bottom down there, 1.4. That means so many people are hedged up and bared that there's no one to turn over. Right here in April of 2025, it got over 1. Anytime you see this all the way over 1, if you just look at this getting up here, 1 January, and you get a big drawdown, that's how you know you're really, really, really getting those great buying opportunities. So just using all of them in tandem and being with your money. Right now we've at 0.833, which is pretty elevated. It actually was up a little bit more in February, but like we said, everything can still spike up a little bit extra. So, but obviously right now, whenever you're looking at all these indicators, all of them overwhelmingly bearish, it's great because the crowded trades never work out. The next thing I want you guys to look at here is the AAII investor sentiment. They've been doing it since 1987, and this is really good to tell how the market is going to be. Look at this right here. This is the highest that we've been since the bottom of the April lows, 46.4% this week. So that means it's a pretty great time to start buying heavy in equities whenever you had the VIX spiking over 30 and we're still going down. Just due to the fact that look at the bearish high. Look what that week was, 62. The week after got a little bit more. That's whenever you really, really want to be buying, whenever everyone's bearish because there's no one bullish. Whenever all these things work in tandems, that's how you really, really know you're getting those great deals in the market, because everyone's selling them to you. Just think of stocks like socks. Whenever you go to the store, like we've talked about before, and you see your favorite socks on Black Friday off 50%. what do? You buy, buy, buy. The same thing applies in the market, everything in equities. You want to go in there and you want to take it because think of this, a stock goes down 50%. And let's even just go up here and let's honestly go here and let's just show something like a Meta, what happened to it in 2022. Right here. Look at how much this stock, what it was, right? Look at how much it went down. At the bottom, down in here in 2022, and went from $377 all the way down, you got into 87. And then this came down to 77. It got over one fifth almost in its size, right? So whenever you come up just to get it back to 386 from 90, that's a 400% gain, a 4x up there to get you to those points. So that's why you always just want to be taking advantages of all these times happening in the market. And even go look in here, looking in April lows, right? It was up here from 740 all the way down to 493. It went down that and you made almost 100% on the way up just from buying the dip right here. That's why whenever you see the market going down, you need to make sure you're first prepared with money on the side, cash, whenever you see the P's and stuff getting highly elevated. Just like right here, if you go and you take a look at what was in January 2024 before the market tanked. We had a 31 on the NASDAQ. Anytime you see anything over 30, even high 20s like 28, 29, that's super elevated forward Ps. And after those points, you kind of know that something's could happen because a lot of people probably have margin, a lot of people are bowled up, and there's really no one to turn bullish, and people are super, super optimistic, and no one's looking to the downside. And whenever all of that happens, that's whenever you get all the moves down. And then whenever, like we've been showing you, whenever everyone's hedged up and everyone's bearish, just like on the fear and greed right here, down to extreme fear 20, that's whenever everyone's also getting bared up at that point, and that's whenever you want to be bullish, just like we showed on the put to call ratio. Whenever everyone is super, super bowled up and you see a really, really low put to call ratio with a higher forward P and people are overly optimistic, that's whenever you almost want to be scared, because that's whenever you could have problems in the market and no one really realizes what could be happening coming. Because just take a look at this, like we showed you December in 2024, everyone was bullish. Margin, look at the put to call ratio is down to 4.5. Look at down here right before the 2022 crash, right before going into that. You're getting a put to call ratio at 0.4. Anything under 0.5, danger zone, danger zone, danger zone. Just because no one's taking any hedging and they're just a super, super risk on market. So you always kind of want to be doing the opposite of the crowded trade. And according to the macro environment and say the micro equities that maybe just get hit for no reason, that's whenever you want to be allocating your cash in the market and you keep enough of it on hand. And just go here, look at the 4Ps whenever you had these crashes. Look at right before anything over 22.5, 23, even getting up to 24 is like really, really dangerous. Look at here, it got up to 24.35 right before the 2022 crash. That's whenever it's screaming red flags. There's probably some problems in the market, and you know that it's probably not going to get much higher. And just to show, we get the 4P ratio is whenever you take your earnings per share from the next year and you take your share price today. So your share price today divided by the next year's earnings per share projection gets you your forward P. It's because we always want to be forward looking in the markets right now. And then whenever you see your forward P is getting low at the bottom of these crashes, that's whenever you want to be buying. Just like everyone says, buy low, sell high. That's the name of the game. And you really want to be looking at these psychological indicators instead of just listening to the news and what people are saying. That's good to hear. If you find all the bears bullish, then it's like, hey, I'm worried right now. But you can really just use this and do a lot of math within the market and understand these type of things to really take advantage of almost every crash. You can kind of see stuff getting high and you just can't be greedy. Obviously a black swan such as a COVID could come, and at that point you can't do anything, but that's very rare for the market to happen. And honestly, most of the times if a black swan happens, it's even able to happen because so many people are bullish. So a lot of these signals will still precede it. And just learning these and looking through them will make you so much of a better investor because you'll be so much more prepared for anything to happen in the future. Now let's just go for a little bit to what's kind of happening today with the 10-year, with that going up with inflation. You can see obviously gas is going up a lot. And a huge problem in the markets that happened right now is that GDP only went up 0.7. It was 4.4 a while ago. Now today it was projected at 1.4%. It only got to 0.7%, really showing the labor market and the economy slowing down. But with this war going on right now, the Fed's hands are completely tied, because whenever energy prices spike with oil, no one can get prices for cheap anymore. They have to start raising their prices because the cost of transportation and to get those goods there goes up exponentially, which means that these prices are going to go up, and then the whole business cycle is eventually people are not going to be able to buy these products at these insane prices. It's going to drop off even more GDP, and then the Fed's eventually going to have to cut rates because inflation is going to stop going up because no one's buying products. And right now, bonds are the thing you really want to watch, because those bond traders are the people that understand the market, and they're not equities, which everyone in equities is driven by emotions of fear and greed. That's why we have a fear and greed index right there, just showing that people, just based off emotion, they like to take momentum trades. They're short thinking. They're not thinking about the future. Whenever stuff's going good, they put the blinders on, and it's only good stuff, and they can't see the downsides. Right now, the data is, if the war keeps going on for a longer time, which nobody knows right now, then there's a chance we have stagflation, because the bonds are starting to even price in inflation going up, which you kind of would have seen with the PCE coming in line expectations today. You would have thought that maybe you could get the interest rates down and have some rate cuts, but since this war's happening and energy going up, the Fed can't do anything, and bonds are front running this and pricing in the inflation that this could cause. It's going to lead to the Fed's hands being tied and possibly eventually having to cut rates. So bonds are almost pricing in some inflation here, which is out no rate cuts. I think I've seen about one rate cut were projected. But going back to all this psychological stuff, while factoring in some of the macro stuff, whenever everyone's super scared of a market, think about back to last April, back to COVID and these drops, and everyone's scared. They're almost the best times to buy, because usually they get fixed up, and that news that people see coming that is bad news, eventually the markets don't react as bad, and that's how you really know you're approaching a bottom, while using the investor sentiments, the fear and greed index, put to call ratios, and the VIX with those spikes. If all of them are checking out, then you know you're probably getting a pretty great buying opportunity, even a generational buying opportunity, if you have all of them over those levels. And then you just have to keep a math in line, the forward Ps of the market, and whenever you take these times in the markets, you want to go and you want to find the stocks that have been hit the most or something. So some of these SaaS plays right here, right? So let's go and put on we can put on SoFi. It's more of a fintech we call, but it's also, some people call it a SaaS play. ServiceNow, let's put on, but that started coming up finally. Let's put on a Zeta here. And let's do a Salesforce right here. Just look at how much these stocks are all down from their highs just a little bit ago. Most of them peaked here. A lot of these have been trending down, but just look at how much these ones have been almost peaked here, right? Just from these highs right here, if we just keep going, you're going to just see that these all are just been getting killed. They're high beta, high growth. And whenever the market is kind of pricing in all of this happening here, this is a great time to buy these stocks, because you're just going to get unbelievable deals on them. If you just look at how much these stocks are down, you got Zeta is down about 4%, but from these highs right here of about, they were at 25, now they're trading under 20 with unbelievable earnings. That's a bargain. Salesforce still down 25%, even though they've been putting up great earnings. SoFi and ServiceNow are down 40% of their highs, and their businesses have only gotten better. Now, some of these are AI fears, some of these are overall market fears in the finance sector. But the point is, whenever you see the market get hit hard like this, the first thing to come back is the stocks that been getting hit the hardest, the growth stocks. So you want to go and find the stocks that you believe in their business models, have a bunch of cash on hand for the balance sheet to survive anything more, and buy those ones, the ones that have been hardest hit, not the ones that have been the least hardest hit. Because those ones still could even go down a little bit or stagnate while all the money flows back in to more of these higher beta growth stocks at the bottom of their sessions. And if you think the market has more chance to go down, you want to get your money more out of these higher flyers, and you want to rotate more into value stocks or dividend stocks and have some in your portfolio at all times so you're balanced and ready for anything. So you just keep rotating money into one, back to the other, depending on the market cycle, that 4Ps, the elevation of the market, just to figure out, hey, should I be in this? Should I be in that? And be prepared for anything happening. So that's kind of the end of the video. Thank you for watching. Just give us a like and subscribe here if you want to see more content, more ideas and analytics about the market. And stay tuned for next week's part 3 of that series. We're just going to give a huge thing about investing and how you should be doing. Next week, I think we're going to go into income statements and balance sheets. And we're going to do another video. It's going to be a special surprise.